Welcome back to The Explainer. Today, we're diving deep into the financial DNA of SLB. If you've ever stared at a company's financial metrics and just felt completely overwhelmed by the sheer wall of ratios, percentages, and acronyms, well, you are in exactly the right place. We're going to strip away all that noise and transform these raw numbers into a crystal clear picture of SLB's fundamental health and valuation as of May 15th, 2026. We're just going to look strictly at what the data is telling us right now. Let's get into it. Here is our roadmap for today. 1. The SLB overview. 2. Pricing and fair value. 3. Analyzing valuation multiples. 4. Financial health and profitability. And 5. Dividend yields and returns.
Kicking things off with Section 1, the SLB overview.
First things first, let's talk scale. SLB is sitting on a massive $82.65 billion market cap. I mean, we aren't talking about some nimble little microcap stock here. This is an absolute behemoth in the market. Keep that sheer size in the back of your mind, because steering a ship this huge takes some serious momentum. And you can see that exact momentum playing out right now. At $55.38, the stock has rallied a staggering 75% off its 52-week low of $31.64. It's hanging out just slightly below its 52-week high of $57.20. So the market has clearly rewarded this stock lately. But, we gotta ask, is this current price actually justified by the business underneath? Which brings us to Section 2, pricing and fair value. Now, this is where things get really interesting, folks. We're seeing a huge conflict in the data here, and this is exactly why we use multiple valuation models. If we run a free cash flow model, it tells us the stock's fair value is $85.63, meaning it's heavily undervalued. But flip over to the earnings per share model, and it's pointing to a fair value of just $48.03. That implies it's actually overpriced by about 15%. This is a classic tug of war between cash generation and accounting earnings. So here's the bottom line. If we trust the free cash flow model, and a lot of hardcore value investors do, mainly because cash is way harder to manipulate than accounting earnings, SLB is offering a massive 35.33% margin of safety right now. Basically, the stock is theoretically trading at a 35% discount compared to the actual cash it's expected to generate for its owners down the road. Let's pivot to Section 3, analyzing valuation multiples. Let's see if the broader market agrees. Turns out, SLB is trading at a significant premium pretty much across the board right now. Take the PE ratio, for example. It's sitting at 24.18. That is over 48% higher than its 3-year average. We're seeing the exact same trend with the price-to-sales ratio up 24% and the price-to-book ratio up over 11%. The market is clearly super optimistic about SLB, and buyers are definitely paying a historically high premium to get in on the action. But wait, this is where it gets a little weird. The PEG ratio is sitting at negative 1.08, which is a really fascinating anomaly. Usually, the PEG ratio compares valuation against growth, but a negative number here, that's largely because the trailing 12-month net income and earnings per share are actually showing negative growth rates, despite that incredible price run-up we just talked about. It's a serious mismatch between backward-looking earnings drops and forward-looking price action. And if we zoom out to the broader enterprise value multiples, which factor in debt and cash to give us a picture of the entire business's value, it totally confirms that premium price tag. SLB's EV to EBITDA ratio is at 11.07. That's about 24% higher than its historical average. So literally everywhere we look in the relative valuation metrics, the data is screaming that the market is charging a premium today. Moving right along to Section 4, financial health and profitability. Let's look under the hood at the actual business. Walking down the income statement, SLB's economic engine looks incredibly robust. They managed to convert nearly $36 billion of trailing revenue into a really healthy 10.44% net profit margin. And get this, that is after paying an effective tax rate of over 19%. Keeping more than 10 cents of pure profit for every single dollar that comes through the door at this massive scale, that is a fantastic indicator of real pricing power and operational control. Next up, let's talk capital efficiency. Essentially, how well are they using their money to make more money? Return on invested capital is sitting at 10.81%, and return on equity is at 12.72%. Now, don't get me wrong, both of those are objectively solid numbers, but it is worth pointing out that they are both currently tracking slightly below their 3-year averages, just a slight recent dip in how efficiently they're turning capital into returns. However, if you're looking for a major green flag for safety, look no further than this incredibly low 0.44 debt-to-equity ratio. Even better, that number is actually 26% lower than its 3-year average. They have a beautifully, responsibly leveraged balance sheet right now. Management is aggressively paying down debt or growing their equity base, which really takes a lot of the long-term risk off the table for shareholders. And that safety totally extends to the short term, too. A current ratio of 1.34 means they've got more than enough liquid assets to comfortably cover their immediate, near-term bills. Even if we strip out inventory and just look at the quick ratio, it's essentially sitting right at 1. The big takeaway here? SLB's financial house is built on a rock-solid foundation, not sand.
Finally, we arrive at Section 5, dividend yields and returns.
So how does all this fundamental health actually translate to your pocket? Well, the company is seriously committed to returning cash to its owners. They're paying out about half their earnings. That's the 50.66% payout ratio to support a 2.13% dividend yield. But the real showstopper here is the growth rate. That dividend has been compounding aggressively at almost 19% a year over the last 5 years, with 4 straight years of hikes. That is a fast-growing income stream for anyone holding the stock long-term. But I gotta warn you, holding this stock has been an absolute roller coaster. Just tracking the last few years, shareholders have had to stomach some wild volatility. We're talking massive gut punches, like a nearly 44% drop in 2020 and a 24% slide in 2024. But then you get these explosive face-melting rallies, like an 81% surge in 2022 and another 45% run in 2026. Make no mistake, this is a highly cyclical play. But, when we zoom out and smooth out all that crazy volatility, the compound annual growth rates paint a really strong multi-year picture. Over 5 years, the return sits at a very respectable 14.26% annualized. And if we measure just the trailing 12 months, a staggering 62.85% return. For the investors who managed to hold on tight and weather the storm, the math has absolutely paid off. So, as we wrap up this explainer, I want to leave you with one final provocative question. We've laid out the data. The traditional multiples, like PE and EV to EBITDA, are trading at massive historical premiums. Yet, the intrinsic free cash flow model is screaming that there's a 35% margin of safety. So what's really happening here? Is the market foolishly overvaluing a recent dip in earnings? Or is it completely underestimating the massive wave of cash this bulletproof balance sheet is about to generate? That, my friends, is the billion-dollar question you have to answer.